Welcome, everyone. If you're following the news these days, there's obviously a lot of things to be pessimistic about. Unfortunately, this creates the conditions for investor self-destruction. In other words, fear-based investment decisions, which typically are the worst you can make. On another note, this weekend is the Berkshire Hathaway annual shareholders meeting. It gives investors an opportunity to ask Warren Buffett and his business partner, Charlie Munger, questions for up to 6 hours. Basically, anything is on the table. Just real quickly, let me share with you some pretty amazing statistics as it relates to Berkshire Hathaway stock. So earlier this year, the stock price blew through the $500,000 milestone. That's right, $500,000 per share. What's more amazing is less than 40 years ago, those same shares were less than $8,000 per share. So in other words, that represents a 500-fold change. Or a $10,000 investment today would be worth roughly $5 million. But here's a question for you to ponder. How many investors do you think have actually held their Berkshire shares for the entire duration of the last 40 years and thus captured this 500x return? I'll bet the number is just tiny. And that really brings me to what I want to talk about here today. That is, what is the biggest mistake or the biggest impediment to achieving these investment returns, whether it's of Berkshire Hathaway or even just the market more broadly? And the biggest impediment that I've observed throughout my career is investors getting in their own way. And that basically comes down to trying to be too clever, thinking you're going to outsmart the market, buying and selling before every drop or every jump. Or people just getting nervous due to major events that are prominent in the news. So this brings me to a great quote from Buffett's business partner, Charlie Munger. That being, the first rule of compounding is to never interrupt it unnecessarily. In other words, if you own a great asset like Berkshire Hathaway, which again is up 500 times over the last 40 years, usually the best thing to do is nothing. Chances are probably close to 100% if you are buying and selling something that is going up like this, your results are only going to be worse. As Munger says, don't interrupt what some people have described as the eighth wonder of the world, that being compound interest. Now, this sounds so simple. Why in practice is it so difficult for people just to hold on? Well, I think the 24/7 news that just is coming at us constantly now makes some of these global events feel more palpable and probably makes people more anxious. It reminds me, another professional money manager that I follow closely that has a phenomenal long-term track record put this list of things in his first quarter letter to shareholders. And his point was, look, everybody's concerned about what's going on in Ukraine right now. But when you look back in history, there's always some crisis unfolding. And although that can hit the financial markets in the short term, when you look back, they end up just being blips and frankly oftentimes end up providing great buying opportunities. In fact, if you look at Berkshire Hathaway even, despite it being up 500-fold over the last 40 years, there's been 4 distinct times when the stock was down over 30%. But I can tell you in each of these times, there was really nothing going wrong at Berkshire Hathaway. Rather, it was just the entire market was down, or in the case of the late 1990s, which was kind of a rare exception, Buffett's style of being a very shrewd and cautious investor was just out of favor. So if we know that even the strongest companies like Berkshire are still not going to be immune from the occasional big market pullback, what are we to do to better position ourselves to make sure we don't jump off the so-called compounding train and screw up making 500 times our money? Well, we can actually look to how Warren has Berkshire's investment portfolio positioned for some guidance in how he thinks about this, because frankly, I think about retiree portfolios in a similar light. So for instance, just real briefly, here is Berkshire's stock portfolio. They itemize the top positions. The total stock holdings are about $350 billion. Down here, they also note that they have about $150 billion in cash/cash equivalents, which basically are short-term government bonds. So if we add this up, the total portfolio is about $500 billion. Roughly a third of that is in safe, secure holdings, cash equivalents that is. And basically Warren articulates this in these couple paragraphs, but he wants the company to be in a position to weather whatever economic storm ultimately comes. And, we know there's going to be a storm every so often. We just don't know the when. And they never want to be in a position where they have to sell any of their stock holdings. They want to be in a position where not only can they hold, but also be a buyer when prices are more attractive. And in a similar fashion, when I'm working with folks that are transitioning in retirement, we're usually trying to do two things. We're trying to create safe, sustainable retirement income, while we're also trying to weigh that out by keeping a portion of the portfolio positioned for growth to outpace inflation. Inflation's a hot topic right now. Inflation's running the hottest it has since the early 1980s. So it's a great example of why we need some of the portfolio position in that manner. So how do you not screw up making 500 times your money? Well, as Charlie Munger so succinctly puts it, never interrupt compounding unnecessarily. And I think that's easier done if you're, right in the prime of your working career. You have many decades ahead of you. It's easier to hold through those occasional big market pullbacks. But if you're later in life, you're retired, you don't have decades in front of you, the best way to do that is very similar to how Warren Buffett has Berkshire Hathaway's portfolio position. You have to segment out your assets so you have a big chunk of safe assets there that are going to allow you to weather whatever economic storm ultimately comes to pass. And as we said, it's not a matter of if, it's just a matter of when. Economic storms are part of the game. They happen, the big ones seem to happen every 5 to 10 years, and you got to be in position to make it through to the other side. Anyway, I hope that was helpful today. Some pretty interesting stats in this thing. Look, I hope we'll see you in the next one. Thanks for watching.